Ladies and gentlemen, a very good afternoon and thank you for being here. My name is Francois van Schalkwyk. I'm the Executive Director for Investment and New Ventures here at NIPDB, or the Namibia Investment Promotion and Development Board. I think without me speaking too much and prolonging the event this afternoon, I would like to introduce our first speaker that will do the welcoming and the opening remarks. She's the chairperson and CEO of NIPDB, Mrs. Noguro Anja, and she'll be followed by the representative from World Bank, Douglas Peers. Ma'am?
Thank you very much, Francois, and good afternoon. I think, Francois, you didn't give lunch. The people are still hungry, and I don't know when you are going to give lunch because I don't feel like I was greeted back. Good afternoon. All right. No, thank you very much, and welcome to the NIPDB. Thank you for joining us this afternoon. I definitely do not have a long story to say. I was told I do not have a lot of time, so I am here to welcome you. But also to say, yes, a few months ago, actually not a few months anymore, it's now 2 years since we kind of started on this journey of what we are doing. And I think most of you know me. It's like I don't know much. I'm just an auditor. And an auditor entering the space of investment promotion, there was probably two things that I realized. Number one, definitely I realized that my training as an auditor has been very useful because of understanding industries and so forth. It has given me exposure to various aspects. But then, of course, I understood that I'm not so sure I knew what I was doing when I started. So I knew auditing, but I found out probably what I was entering into, I underestimated what is here. And then what we then realize is the importance of partnerships, saying that, yes, you don't need to know everything. You don't need to have all the resources. You just need to have the right connections, know the right people, and then you will be able to find solution. And I think that is probably what we have been doing as a Namibia Investment Promotion and Development Board for the last 2 years, is trying to form partnerships, whether it is with colleagues in the various ministries, agencies, and offices of government, whether it is with the private sector, whether it is with development partners, and then trying to bring everybody together. Because if there is one reason why we ended up here is saying, yes, we need to pull in the same direction. That is what our president always says. Harambe, let us pull in the same direction. Let us work together, because only then can we solve the challenges that are facing us, the triple challenges of poverty, inequality, and unemployment. And yes, we acknowledge that we need investment, and especially private investment, for us to be able to solve those challenges. But we cannot solve them if we are not pulling in the same direction. And therefore, we need government taking hands with the private sector, taking hands with the development partners, civil society, and everyone, so that we can pull in the same direction. And therefore, we are here almost as a coordinating organization that is trying to really create a platform of saying, how do we come together so that we can tackle challenges? And then, of course, how can we learn from everybody? Because like I told you, I'm just an auditor. I don't know much. But I need to know much in order to support more people. And I need to connect people. And therefore, we bring together various partners. And that is one of the sessions today, looking at, yes, what kind of investment policy that we need to have in place, and how do we collaborate better in that space if we as Namibia need to attract investment and need to do well there. So thank you very much for coming and for being part of this conversation. You are welcome here, and we look forward to hearing your input. We look forward to collaboration. And we look forward to implementing many things that are coming out of here together. Thank you, Francois.
Thank you very much, Mrs. Wanja. Our next speaker will join us online. Like I mentioned, he's the practice manager at World Bank, Douglas Pearce, and he will be speaking on behalf of the country director for World Bank.
Okay, thank you very much. Just to check that you can hear me okay.
We can hear you, but not see you.
Okay. No? Okay. I can continue without, in the meantime. I'm going to keep the remarks fairly brief. I mean, first, I think I'd just like to congratulate the NIPDB for organizing this important knowledge exchange event with the World Bank Group. We're very pleased. And the global economy, from shocks, from inflation, from rising interest rates, declining FDI, and the increasing reality of climate change. And if you allow, I'd like to briefly highlight findings of the country private sector diagnostic that was conducted recently in Namibia. This identified priority reform opportunities to address 5 cross-cutting bottlenecks. First was enhancing the role and performance of the state-owned enterprise sector through a more effective competition policy environment. Second was strengthening implementation of the public-private partnership framework to expand private investments, especially in infrastructure. Third was leveraging the potential for digital transformation of the economy. Fourth was addressing inefficiencies in logistics and trade facilitation. And fifthly, tapping opportunities in the water sector for green and resilient growth. So I would encourage the analysis and the findings in the country private sector diagnostic to be one which is, which is referred to and made full use of. There's a lot of very valuable material there. So finally, I just like to say, I look forward to the next actions that come out of this event today. And I look forward to the continued collaboration and partnership that we have between the World Bank Group and Namibia. So I trust the the camera worked out, and I wish you all the very best for the discussions today. Thank you.
Thank you very much, Douglas. Thank you. Ladies and gentlemen, yes, I think Douglas has nicely captured what the afternoon will really be about. But I think the brainchild behind this event and a number of other World Bank and NIPDB events that will follow through the course of this week is Ganesh Razagam. He's based in Johannesburg and is the lead private sector specialist for finance, competitiveness and innovation at World Bank in Africa, or in sub-Saharan Africa. Welcome and thank you very much for being here with us. And we look forward to the rest of the program. Thank you.
Thank you, Francois. Thanks very much. Always a pleasure to be back here in NIPDB offices. I feel like I actually have an office here, Francois. The amount of time I've spent here. So this part of the session will be we'll start with a presentation from my colleagues who are in Washington. Peter Cusack and Priyanka Kher, who are both connected. They're both global experts in investment promotion and policy. They've been working on this agenda around the world. So we have them today to present to all of us the highlights of a recent World Bank report called the Global Competitiveness Report, which is still to be publicly launched, but they're going to share the primary findings, the trends and dynamics of FDI globally, with a focus on Namibia. And the other presentation will be a recent analysis that we have been carrying out with SADC. It's called the Investment Climate Scorecard, where it's a benchmarking of the investment or the FDI regime across SADC countries based on an OECD methodology, which again my colleagues will present, and again we'll talk about Namibia. So after the presentations, we'll have a distinguished panel whom I'll introduce later, who will share their insights and their reactions to the presentation, followed by a Q&A for all of you to participate and ask questions and share your insights. So let me just introduce Peter and Priyanka to start your presentation. I hope the connections work, Peter. We can't hear you, Peter. Can you hear me? No, I'm sorry. We still can't hear you, Peter.
How about now?
Yes, we can hear you.
Yeah. All right.
I'm sure we can see you shortly as well.
Great. Thank you for your warm words of welcome. Good afternoon. It's our pleasure to be with you. Let me not touch anything else in terms of my audio and video settings and just go straight to sharing the PowerPoint slides, lest I mess things up again. Window, share. Let's see. Ganesh, can you now see the opening slide?
Yes, we can see and hear you, and we see the slides. Thanks, Peter.
Wonderful. Let's get started then. So again, our pleasure to be with you. I'll provide an overview of the global and regional FDI trends based on our forthcoming Global Investment Competitiveness Report, and then I'll pass the microphone over to my colleague Priyanka. I'm a senior economist with the Global Investment Climate Team and also the lead author of this global report. So let's look at the current global context that's affecting the operations and decisions of multinational corporations. And one way to appreciate this challenging global context is through a framework of 4 C's. First is the conflict in Ukraine, which has been increasing energy and commodity prices, contributing to growing global geopolitical tensions and overall rising business uncertainty. The second C is the cost of capital, the rising cost of capital transmitted through the rising interest rates in the US, in the European Union, that are increasing the cost of corporate borrowing, as well as having spillover effects on the developing country currencies and ultimately the economies. Through this rising inflation that we've been experiencing and the specter of recession, both these are collectively dampening business prospects again. The third C over the last 2.5 years, 3 years, has been COVID outbreaks. We saw that until quite recently, China's zero COVID policy or a lockdown has led to continued supply chain bottlenecks and various disruptions to the global movement of goods, and as a result affecting both trade and investment. And the fourth C is both a threat and an opportunity, and it's that of climate and green growth, imperatives that are changing decision-making options for multinational corporations. So with this context, I wanted to organize my presentation around 4 main messages. The first is around FDI stagnation, volatility, and uncertainty. We saw that the uncertain and deteriorating economic environment resulting from a series of overlapping crises has presented an unprecedented volatility and uncertainty for FDI and for international production. And while challenges are really global, the impacts on developing countries have been particularly dire. Foreign investment has responded to the various shocks of the last 3 years with heightened volatility. It fell by 40% in 2020, then rebounded sharply in 2021 to reach prehistoric levels, before the pre-pandemic level, sorry. The high-income countries recorded both the steepest declines in FDI inflows in 2020 and also the quickest rebounds in 2021. The COVID pandemic effects on low-income countries and lower middle-income countries have been relatively muted. At the same time, FDI performance in these lower-income countries has stagnated, as we can see, for nearly a decade. And the volatile FDI trends over these last few years since COVID have exacerbated and in some ways accelerated the longer-term investment trends of the last decades. So if we can see, as on this graph, the global FDI flows have really stagnated since the global financial crisis of 2008, 2009. And this has been due to a combination of economic, technological, and policy factors. The dynamics of FDI have been defined by structural transformation towards services, increasingly asset-light forms of investment enabled by digitalization, and higher economic policy uncertainty. This uncertain environment for investment has been underscored by the waning public support and correspondingly political stance in many countries regarding globalization in many parts of the world. Countries have been increasingly attuned to the adverse distributional consequences of global trade and investments. On the one hand, globalization's economic dividends have been widely documented. At the same time, its role in increasing economic disparities and growing income inequalities has been underappreciated, and in some countries prompting protectionist policies. Now, if we look at the FDI performance of individual developing regions, we see interesting trends. The blue lines on this graph represent several Asian regions and countries. The dark blue line on top shows China, a steady performance over the last 20 years. And then further down, the lighter shades of blue refer to East Asia and the Pacific and South Asia. The other lines, gray referring to Latin America and the Caribbean, and orange referring to Eastern Europe and Central Asia, while still in the top half of the graph, you can see the volatility and really the stagnation, especially when we look at ECA, Eastern Europe and Central Asia. We see the FDI performance peaking just before the global financial crisis in 2007 and 8, and really stagnating, a sharp downturn and then stagnation since then. But let's zoom in on Sub-Saharan Africa. That's the green line at the bottom of the chart. A slight relative increase over time, but at the same time, quite a stagnating performance as well. Slight decline since 2015 over the last 7 and 8 years, slump during the years of COVID, slightly so, and then a strong uptick last year, suggesting opportunities, and we'll be focusing on those going forward to really discuss what are some of the opportunities to make sure this upward sloping trend is sustained. On this graph, we see a similar performance. Rather than looking at aggregate FDI flows through official statistics, we are looking at greenfield FDI announcements. In this graph, Sub-Saharan Africa is presented through a dark blue line at the bottom of the chart. So again, we see a relatively flat performance over the last 10 years, and then the decline due to COVID. And this particular graph is not yet showing the uptick experienced last year. Now, here we are looking at a graph to show us that the last 2 years have also seen a reversal of a longer-term trend whereby developing regions were accounting for an ever larger share of global FDI. In 2019, more than 40% of global FDI flows went to developing countries, compared to a low of just 22% a few years earlier. The latest evidence, unfortunately, points to FDI flows to developing regions growing more slowly in the last few years since COVID. So this gap, again, is widening. We were hoping for convergence, and over time, developing countries accounting for majority of global FDI, but the trend lines are, again, diverging. Now, this has been the historical performance. So let's happening and zoom in on the present day and look at what the FDI figures look like for 2022. And we see, despite the recovery of FDI in 2021, the environment for cross-border production and investment shifted dramatically again in 2022. It's with a decline, particularly with the impacts of the pandemic and the war in Ukraine, affecting supply chains and causing new inflationary pressures. So it's really the 4 C's, the various crises and shocks that I presented that are affecting just last year's FDI slump. Projections for next year also indicate that persistent macroeconomic and political shocks will lead to heightened investor uncertainty that could further discourage investors and exacerbate risks. In fact, a pulse survey of multinational corporations that we conducted last year reveals that nearly 30% of them plan to reduce their investments in developing countries in the coming year, citing shifting corporate strategies as the main reason. And for this trend slide, let's zero in on the performance of Namibia. Of course, all of you in the room are much more familiar with these figures than me. But on the top row, we see Namibia's volatile FDI inflows performance over the last 5 years, with some negative figures, divestments reported in 2019, 2020, and then a strong surge in investment in 2022. This has also on the right-hand side of the slide translated into the share of FDI in gross fixed capital formation, which is one measure of total investment in an economy. And we've seen that the FDI contributions have ranged from, at times, negative figures. Again, this is due to divestment and declining investment to, in 2021, FDI accounting for nearly 1/4, a quarter of gross fixed capital formation. Let's compare Namibia's performance to that of Sub-Saharan Africa further down the slide and the developing economies as a group. And let's just look at the percentages as a FDI as a share of gross fixed capital formation so that we are comparing apples with apples in terms of the relative figures. So here we see that for Sub-Saharan Africa, FDI has consistently contributed about 8% of gross fixed capital formation versus the volatile trend in Namibia. And in fact, Sub-Saharan Africa has been doing quite well in this regard relative to the rest of the developing regions, where FDI's contributions to total investment are slightly lower at around 6.5 up to 7%. So while Africa attracts a relatively small amount of global FDI relative to the size of African economies, it's actually a bit more than a typical developing country, or for that matter, a typical country. As we look at the very bottom of the graph, these are averages for world, including high-income economies as well. So these have been the recent trends in terms of flows and stocks of FDI. For the second main message, I would like to look at the shifting FDI patterns that are creating both new risks and opportunities for developing countries. And underlying the volatility of FDI flows that we've looked at have been gradual but persistent shifts and pivots in multinational corporations, organization of international production, and the associated FDI location decisions. These have had significant effects on the geographic organization of FDI, referring to reshoring and nearshoring, on the sectoral organization of global FDI, such as the rise in services FDI, and structural distribution and composition of FDI. And here I'm referring to the rise in special purpose entities, or what's sometimes called and referred to as phantom FDI in offshore financial sectors. Now let's zero in first on these geographic changes in reshoring, nearshoring, and early evidence of friend-shoring. Based on an extensive survey of more than 1,000 large multinational enterprises, we see that the majority of companies, in fact more than 55%, expect to undertake some near or reshoring of their production in the next 2 years. The main drivers of these shifts include diversifying production to protect against future shocks, trade and policy and investment policy motivations, and continuing demand and search for talent and for skills. About 1/3 of surveyed MNEs also expect to become more vertically integrated and to handle a larger share of activities in-house instead of relying on outsourcing. Survey respondents expect to reallocate their investments both within regions as well as across world regions, with the following key patterns emerging shown on the graph. The East Asia and the Pacific region, that's the blue box on top of the graph, is likely to experience a significant intra-regional reallocation of investment driven to a large degree by MNEs diversifying production to the regional markets outside of China. The survey data reveal that EAP has a large share of firms expecting their highest investment reduction, yet at the same time, a large share of firms expecting a highest expansion. this really suggests that EAP will continue, East Asia and the Pacific will continue to dynamically transform as firms move in and out of the region, as well as between countries within the region. Next is South Asia, the lighter shade of blue, which is expected to see an increase in investment as MNEs shift assets away from East Asia and the Pacific and Latin America. In sub-Saharan Africa, we expect relatively modest shift, at least as reported by this specific survey we conducted last year. Now, it's really China and India globally that stand out as countries expecting significant planned investment reallocation in the coming 3 years. So on this graph, we're zeroing in on China, and the two key trends that appear to be driving investment reallocation away from China are the China Plus One diversification strategy, where businesses seek to expand operations in other cost-competitive locations, such as India, Indonesia, Philippines, Vietnam, Malaysia, so staying within East Asia and the Pacific. And the second trend is nearshoring and reshoring motivations of firms, with multinational enterprises' plans to shift production closer to their final consumer markets, particularly in North America and the European Union. The survey results, however, showed that given China's significant market size and continued dominant role in global value chains, trade, and investment, it's likely that investment reallocation out of China will be accompanied by new investment activity stemming from other multinationals seeking market access to China. The second trend I highlighted refers to sectoral changes, rise in services, foreign direct investment, non-equity modes of investment, asset-light forms of investment, and green and resilient investment. So on this graph, we are looking at the composition of FDI flows that's been increasingly tilting towards services, fueled by investment in intangibles and asset-light forms of international production. Of course, COVID-19 pandemic has further accelerated these trends with increased demand for digitalization. And the FDI in services now accounts for a clear majority of total greenfield FDI project announcements in both developing countries and globally. Here we can see that the climate crisis and search for resilience are also increasingly changing FDI landscape, with FDI shifting out of polluting sectors and into green sectors. The green sectors now clearly dominating the FDI landscape. The third change in patterns has to do with financial globalization, intangibles, and MNC's international tax practices that have been driving a growing wedge, or a decoupling, if you will, between official FDI statistics and FDI in productive economic activities. What does this mean? It means that estimates suggest that phantom FDI in special purpose entities, which are often investments in corporate shells in offshore financial centers, now accounts for about 1/3 of global FDI stocks, as reported in official FDI statistics. For example, Luxembourg or the Netherlands are amongst the top 3 global FDI hubs when it comes to official FDI stock statistics. Now, this is clearly disproportionate to their market size or the role they play in international trade. The strong presence of these special purpose entities in these economies breaks the link between the receiving economy and the ultimate owner, and as a result inflates global FDI, since special purpose entities are pure financial intermediaries rather than final investment targets. Now, to curb this trend of MNCs profit shifting, and in order to increase their tax contributions at an individual country level, a global minimum corporate tax agreement was negotiated in October 2021 by a majority of the world's countries. This agreement is expected to reduce the use of tax havens by MNCs to shift profits out of their main operating countries. It will also limit tax competition between developing countries by setting a minimum tax rate of 15%. This step is hoped to reverse a decades-long race to the bottom in corporate taxation. And projections also show that the agreement will increase tax collection in most countries, allowing governments to strengthen domestic resource mobilization and spend more on much-needed areas that foster sustainable economic growth. And that brings us to the third main message. FDI has been a key engine of growth and can spur sustainable development. But not all FDI has been equally beneficial. Going forward, FDI has the potential, with the help of smart policies and programs, to support sustainable development and to engender green, resilient, and inclusive growth. So let's unpack the relationship between FDI and development a little bit more. The continued, here we see the relationship between FDI and the growth of GDP and exports through examples of 3 East Asian economies, Malaysia, Vietnam, and China, as well as one economy in Costa Rica. So it's clear the relationship of how FDI has been contributing capital as well as skills and managerial quality, and how these have translated into these positive economic outcomes. In fact, and here a deep dive on Vietnam, appreciating the rise, parallel rise of Vietnam's FDI and its export. In fact, a large share of FDI Vietnam attracts is export-seeking in light manufacturing and other export-seeking industries. FDI has been the largest capital flow to developing countries, matching or exceeding remittances and official development aid. As we can see, it's also been much more stable than portfolio capital. Evidence also shows FDI has created more and better paid jobs, fostered knowledge spillovers, and lifted people out of poverty, boosted exports, economic diversification, and productivity. But it has also contributed to increases in income inequality, given its distributional impacts on the more vulnerable members of the society and economy. This means that not all FDI is equally beneficial. FDI increasingly, and evidence increasingly suggests that some types of FDI are more conducive to stimulating growth and structural transformation than others. For example, growth effects from FDI tend to be larger in those industries that have higher skill requirements, in products and industries that are tradable and that are export-oriented. As we saw, investment in corporate shells with little economic impact makes up a third of global FDI stock versus the remaining 2/3 of productive, economically oriented FDI. We've also seen that unequal distribution of FDI across the regions of the world means some countries are left behind. As a result, the growing consensus suggests that economic growth and FDI's contributions to it, of course, need to be sustainable, focused on reducing inequalities and making economies more robust against emerging shocks. The World Bank's green, resilient, and inclusive development agenda, the GRID agenda, highlights the importance of these factors and provides a helpful framework of analysis. For the fourth main message, and the last one, we'd like to turn to the role of public policies and regulations. Now, in this increasingly competitive global environment for FDI, developing countries have to redouble their efforts to attract and retain investment through a sustained focus on improving their policy environments. A policy agenda anchored in the ABC of investment competitiveness to attract, to bolster, and to connect FDI, can increase countries' competitiveness for FDI and maximize its contributions to sustainable development. Policy considerations for green, for resilient, and for inclusive development should be an integral, not a complementary, part of the strategic policy agenda for fostering FDI's development potential. So, zeroing in on what these three letters for investment competitiveness framework stand for and what are some of the actions, the A in the ABC, of course, stands for attracting productive FDI and or international tasks and segments in international production in regional and global value chains. In the lower half of the graph, we see some of the investment policy dimensions associated with this pillar. They refer to an open entry regime, a transparent and streamlined investment facilitation system, targeted investment promotion, and smart and limited use of investment incentives. The second letter of the framework, B, refers to bolstering existing FDI for reinvestment of corporate earnings, increase in investment, and expansion of operations. We see that in many economies, the bulk of annual FDI recorded comes from reinvestment by existing foreign-owned firms, not necessarily by new greenfield FDI that comes in, really highlighting the importance of facilitating this reinvestment or expansion of existing operations. How best to do this? From an investment policy tools dimension, it's an appropriate investment protection framework balanced with regulatory space, new approaches to international investment agreements, and proactive investment retention mechanisms, including targeted aftercare, grievance management mechanisms, conflict prevention mechanisms, and comprehensive retention programs. The third policy pillar, Connect, refers to connecting existing FDI with local firms through deepening integration and spreading the gains of FDI. The policy tools here include the demand-led approach to promoting FDI linkages and spillovers with local companies, smart incentives to stimulate these types of spillovers, and policies that strengthen firm and economy level absorptive capacity to make sure that there are programs to stimulate the productivity and the growth of domestic firms through SME promotion, human capital development, research and development investments, and other tools to strengthen the domestic private sector so it can play a strong partner for foreign firms, and we can realize this connection potential. Now, what does this all mean? It means that regulators and governments have a fundamental role in driving the transformation of businesses towards the future, towards sustainable future. And here we are bringing the latest survey evidence showing that local regulatory environment changes are among the top reasons for shifts in investment. We saw earlier in my presentation the changing dynamic landscape of FDI flows both within world regions but also across world regions. And we said at the time that one of those drivers of these shifts and pivots are changes in policy environments. And here is a survey evidence demonstrating the role of government policies. Similarly, when asked about the top 3 drivers of investment location decisions, foreign firms report political stability, macroeconomic stability, and the quality of the legal and regulatory environment for investment amongst their top 3 wishes of what a country can provide in terms of a competitive and attractive environment for investment. So let's recap the main messages. 1, FDI flows have been stagnant and volatile, and the future, unfortunately, looks uncertain. At the same time, shifting FDI patterns are creating, on the one hand, risks, but also opportunities that can be seized through smart policies, programs, and actions. Number 3, FDI continues to play a key role in growth and can be a key instrument in spurring sustainable or green, resilient, and inclusive development. How best to achieve it? It's the role of policies and regulations that play a key role in realizing this potential and promise of FDI. So as Ganesh said, these are kind of sneak preview findings of our upcoming Global Investment Competitiveness Report that will be launched in the coming months. It will be a third in a series of biannual global reports on the current state and the future of FDI. With this, let me pass the microphone to my colleague Priyanka Kher to zero in on our work in Southern Africa. Priyanka?
Thank you, Peter. And good afternoon, everyone. Pleasure to be here. So I think we wanted to share with you, as Peter mentioned, that we wanted to share with you one recent initiative that we've been working on, which is this preparation of the SADC investment scorecard. Next slide, Peter. But perhaps before going into an overview of this initiative, we wanted to situate this work in the broader sort of context of investment policy reforms. And this very much links to what Peter explained under the ABC investment competitiveness framework. So we've seen that to be able to attract and retain FDI, countries systematically need to engage in reforms and implement measures across what we call the investment life cycle. So you'll see here, this circle is basically the investment life cycle. It's often how investors think about a location as well. So starting right from the point of developing an FDI strategy, a national FDI strategy, which speaks to the national development goals of the country, to then creating a framework which is suitable for investment attraction and promotion. Here, we essentially would look into 2 dimensions. One, from an institutional perspective, whether there is a suitable institutional setup, including an investment promotion agency, which is capable of effective service delivery to investors. And second, where there is use of instruments such as incentives to induce certain kinds of behaviors. Those are limited, they are well targeted, linked with policy objectives, and are done transparently. So once the investor is attracted to a country, then we really move to the next phase, which is what does the framework for entry and establishment look like? So what are the rules that affect investment entry, their establishment, the processes that the investor needs to go through to establish in a country? And the SADC initiative, we'd say, primarily is focused on this phase of the investment life cycle, which is the phase of investment entry and establishment. Moving on, when the investor is in the country, how well is he protected? And as Peter was saying, we've seen globally that about 30 to 50% of FDI is coming from existing investors. So how are these existing investors treated in the country? If they have issues, how are those issues resolved? How effective is it? And how effective is the general problem-solving framework in the country? So that's on investment protection and retention. And finally, once the investor stays in the country, what are some of the policy measures in place for the foreign investors to link up with domestic investors? So that is broadly the investment policy and promotion reform life cycle. And the SADC initiatives, like I said, would fall within one small subset of this full life cycle, which is on investment entry and establishment, which focuses primarily on legal and regulatory barriers, impediments to investment. Next slide, please. So Peter shared some survey results, including from our most recent Global Investment Competitiveness Survey. We've seen time and again, we've been doing this survey for a while now. Before that, we had the World Investment and Political Risk Survey. And consistently, since 2009, we've seen legal and regulatory frameworks matter and impact FDI inflow. More empirically, the OECD has its FDI Regulatory Restrictiveness Index, which is what the SADC investment scorecard is based on. And it essentially measures the de jure or statutory barriers in a certain limited topics. And we'll go into that in some detail in the subsequent slides. But essentially, what the empirical finding is, there is a negative relation between the level of FDI restrictiveness in a country and the FDI ability of the country to attract FDI. Here we see it from the perspective of greenfield FDI projects. And it is estimated that the introduction of reforms liberalizing FDI restrictions as measured by the Regulatory Restrictiveness Index by about 10% can increase bilateral FDI inward stocks by about 2.1%. So this is based on OECD's FDI Regulatory Restrictiveness Index, complemented with the years of survey results that we've just discussed. Next slide, please. So then this brings us to the SADC Investment Scorecard Initiative. This initiative essentially measures legal restrictions on entry of foreign investors in SADC member states. 15 member states were covered here, looking at economy-wide issues, but also entry barriers in 22 specific sectors. And the whole objective of this exercise was really to, help the countries monitor trends and changes in the legal treatment of FDI, benchmark one state against the other, facilitate dialogue with SADC member states, and ultimately also, enable the capacity of the SADC Secretariat to monitor its own regional integration initiatives. Next slide, please. So very importantly, as we mentioned, the investment scorecard methodology essentially is the OECD's Regulatory Restrictiveness Index methodology. What it does is it measures the statutory measures, so only the de jure measures, on 4 policy dimensions. Number 1, foreign equity restrictions. So this includes cases where there is a de jure or a legal prohibition for foreign investors to invest in particular sectors in a country. It also includes situations where there are equity caps or limits on the amount of foreign equity that might be invested in a country. Second policy area that's covered is discriminatory foreign investment screening and approval requirements. We've seen a surge of screening and approval requirements globally. So this index is essentially measuring which countries have this sort of a screening or approval requirement only for foreign investors, not applicable to domestic investors. Third, it looks into restrictions on employment of foreign key personnel, and this includes issues such as mandatory membership on boards of nationals or other restrictions on work permits for top key management personnel appointment. And then there is a residual category of other restrictions, which essentially looks at issues such as, ability to repatriate profits, fees, and then also ability to open up branch offices and things like that. So a few residual issues. Discrimination is the key kind of lens with which this index identifies or maps measures, right? Next important point is the scores, as we saw in the previous empirical research results as well. The scores range from 0 to 1, 0 being open, 1 being more closed. Very important caveat, the index, the scorecard is focused on de jure measures, so it does not capture de facto implementation. It does not capture nature of corporate governance, extent of state ownership, and other institutional or informal restrictions. So it's purely a de jure measure. Next slide, please. Okay, so with this, we'll quickly go over some of our key results. So one you'll see here in the first graph, we've got all 15 member states participating in this, or that analyzed for the purpose of the scorecard. We see that a total of 384 measures for all SADC members were identified. The average number of measure per country is 26 measures per country. And when we say measure, we refer to a de jure provision in the law, which is on those 4 topic areas. So equity restrictions, equity ceilings, screening and approval, other restrictions, restrictions on key management personnel, foreign personnel. So in those 4 areas, the average is 26 measures per country. 9 states, including Namibia, record 25 measures or less. So that's in terms of the total number of measures. In terms of sectoral distribution, the SADC investment scorecard looked at measures horizontally, but across 22 sectors. We see that the average number of sectors having a restrictive measure is 13 out of the 22. And so we'll see how Namibia does in the subsequent slides. But 13 of the 22 measured sectors. Next slide, please. The performance of countries on the 4 policy areas has been quite, there has been variation across the countries. So you'll see in this graph, you've got all the countries listed and then distribution per the policy measure, per those 4 policy measures. We see, for example, Seychelles uses most extensively foreign equity limits with 21 measures. We see Mozambique witness a larger use of screening and approval measures, 13 measures each. 13 measures. Zimbabwe uses restrictions on key foreign personnel. And then finally, we see, for example, Madagascar uses extensively other types of measures. So that's just to say that there is a lot of variation in terms of the use of policy measures across the 15 countries. Next slide, please. So then zooming into Namibia and a quick summary of our results there. Namibia has a score of 0.14 compared to the 0.2 average of SADC, so performs better than the SADC average. The average number of measures is 25.4 in SADC. In Namibia, we have 25, so right about at the average number. And then in terms of the policy measures, we see it's seven measures on foreign equity limits in comparison to 11.9 at the SADC level. Screening and approval, 2 measures in comparison to about 2.9 at the SADC average level. I think the measure that's most used more than the SADC average is the restrictions on key foreign personnel, with 7 in Namibia and 2.7 as the SADC average. And then finally, on other restrictions, 9 measures in Namibia compared to 7.9 as a SADC average. Total number of sectors, as we mentioned, 22 sectors were reviewed. The SADC average is about 13.6, and Namibia stands at about 12 sectors with one of these measures, at least one of these measures. So that's a quick summary of Namibia's performance on the SADC investment scorecard in comparison to what we saw as the SADC average. And this is essentially a stock take exercise. Let's go into a little bit of detail on what kind of measures we saw in the analysis. So for example, on foreign equity limits, we saw foreign shareholding in telecommunications firms is limited to 49% of the voting capital under the Communications Act. On screening and approval, we saw that in distribution and retail sector, foreign investment above 49% of share capital requires the approval of the Minister of Trade and Industry. This is under the Foreign Investment Act. On restrictions on foreign personnel, which was the most prevalent type of policy measure that the scorecard finds in Namibia, a foreign investment in the financial services sector, the portfolio manager and compliance officer of an investment managing company in Namibia must be a Namibian citizen. And then finally, in terms of other restrictions, we see that in the forestry and logging sector, foreign investors and foreign majority-owned companies in Namibia cannot acquire or lease agricultural land, as well as shares in a company owning agricultural land without prior consent of the minister. So, like we said, this initiative is essentially a stock-taking activity just to set sort of the baseline on where things are on one specific policy dimension of the overall investment policy framework. So as we discussed, there are several areas of reforms. This zooms in on certain de jure aspects. But it does provide a baseline on what are perceived to be FDI barriers based on years of sort of extensive empirical research, but also investor surveys. What's important is to take this as the current stock take on these issues. But importantly, we wanted to highlight 2 initiatives which really are recent developments to mobilize more investment policy reforms, given that the benefits that they bring with them. So next slide, please. So the first is the AFCFTA. As we know, the AFCFTA investment protocol has now been concluded. And we know, and last year the bank came out with a report on this. there is tremendous potential to encourage new FDI, but also diversify into new sectors. Our initial our analysis from the report shows that there are, full implementation of the investment of the AFCFTA, including on the FDI dimensions, as captured in the investment protocol, could lead to an increase in intra-Africa FDI by 68%. And a total increase in FDI by about 159%. But of course, to make that happen, you need corresponding reforms. Some of those topics speak to the issues that we identified in the SADC investment scorecard, but the scope of reforms needed is much wider. And here in this slide, you'll see that the investment protocol has essentially two elements. One is a set of binding commitments that member states have to comply with, and second is a set of commitments which are more encouraged. This slide summarizes binding commitments, which means member states have to implement domestic reforms to reflect at least these dimensions. And very quickly, we won't go into the details of these, but the broad buckets are alignment of domestic laws, including the investment legislation. Second, designating mechanisms, so including things like, Peter referred to in his slide, retention mechanism, dispute prevention mechanism. That's now a binding part of the investment protocol. Designating a national focal point, which could be the investment promotion agency or other agency that is has the capacity to engage in broader facilitation and information provision to the investor community. Third, on facilitation measures, here the protocol makes specific mentions to visas and work permits, along with a few other issues, and largely specific measures and initiatives to facilitate sustainable and green investment. And here, important to call out would be the ask to do more on health-related investments, and of course, broader green investment. So this is an important opportunity to mobilize investment policy reforms, in addition to the various inputs we've received from the investor community over the years. Second development that we also want to highlight, next slide, please. And we'll end with this, is key opportunities that are presented by the WTO's investment facilitation agreement. As you know, currently as of early this year, 112 members had subscribed to it, are participating in this. And this agreement as well has a set of policy measures which again require domestic reforms. And again, the set of categories could be classified into 4 buckets here again, looking into transparency of investment measures, streamlining and speeding up administrative procedures, setting up focal points, domestic regulatory coherence, and then finally on sustainable investment. So to sum up, the SADC investment scorecard presents a certain baseline on specific de jure barriers in these countries. Indeed, it's a starting point, but great opportunity exists with countries needing to align with the AFCFTA investment protocol, and also ultimately also benefiting from what's happening at the WTO level with investment facilitation. So I'll stop here. Thank you.
Thank you very much, Priyanka and Peter. And I hope you'll stay on for the panel discussion and for the Q&A session. Thanks again. I would like to now invite our panelists to please come up and come up to the podium. Francois, starting with you. Mr. Benedict Libanda. Helen. Philip. I don't know where's okay, great. Great, so please have a seat. I'll sit here. Yeah, you can have that mic over there. Well, fantastic. Great. So first, let me introduce our panelists, and I'm sure you know all of them. Philip. Mr. Philip Chapman is the CEO of the Rand Merchant Bank in Namibia. Thank you, Philip, for making time to join us today. Ms. Helen Amopulo, Head of Investment, Development Bank of Namibia. Welcome. Mr. Benedict Libanda, CEO of Environment Investment Fund of Namibia. Thanks for being here. And of course, our friend Francois is our host and our fellow panelists. So you heard the presentation from my colleagues. They covered a number of areas. So let's have a conversation about Namibia. So I'll ask all of you the same questions, basically, and you can choose to respond to any of those questions. The first question would be what elements of the presentation sort of resonated with you? What did you take away from the presentations in the context of Namibia? CEO, I think the setting up of the Investment Promotion Development Board is a fantastic, let's say, policy innovation. I think you're way ahead of the curve. That's amazing and that's successful. So what's next? How can we build on that and take the agenda forward? So I wanted to highlight a few things. The importance of FDI for green, resilient, and inclusive development in Namibia. So how can we leverage FDI to achieve those objectives? You heard about the importance of the policy and regulatory environment for investments. You heard about the ABC agenda, attracting, bolstering, and connecting investments. Attracting, of course, is getting in new investments. Bolstering is how do you keep your existing investors happy? Because I think the best promotion, investment promotion you can do is a happy investor saying, come and invest in Namibia. So how can you investment retention, aftercare, retention, aftercare, and so forth. And of course, connecting linkages between the domestic investments and foreign investments, growing the domestic private sector. How can we achieve that? So the ABC agenda, how can we bring that to Namibia? The importance of the African Continental Free Trade Area opportunities that are coming up. You heard about the investment protocol from my colleagues. You heard about the WTO investment facilitation agreement. These are global opportunities that Namibia can benefit from. So I wanted to sort of pose these questions to you, colleagues, and maybe let me start with Helen, if you don't mind, because you're the only woman on the panel we have. So, Helen, over to you, please.
Thank you, Ganesh. I think the presentation was very enlightening. I'm happy to have been part of the first group to actually see the insights that it has given us. There's a number of issues that have been highlighted that are also fundamental, not only for Namibia as a country, but also for DBN as an institution and other development partners that are in the room today. What resonated for me is the opportunities of foreign direct investment in developing countries. You saw that uptick between 2020 and 2021. So that rise basically is telling us that we need to position ourselves as a country, both politically and economically, to attract and absorb these investments. The question is, are we well aligned and are we ready to absorb all of these investments? We are in an era where Namibia is actually a darling in the SADC region at the moment. There's a lot of sectors that have come about. Green hydrogen that Menangula's team has been so wonderfully promoting for us. There's discoveries in the oil and gas sector. We've also had the recent development in our utility sector, especially the energy sector, the opening up of the market through the MSB model and so many other opportunities. So the question is, how are we aligned as a country to basically attract these investments, retain them, protect them, and make sure that the local Namibian actually benefits from them? So as a development bank, if I now come back institutional-wise, we have to take cognizance of these rising developments. We are in a constant drive to, number one, I think fundamentals, you need to understand the sectors. It's no use wanting to be part of a sector that you don't understand. So there's a lot of effort in aligning the team, in actually appreciating the developments of these sectors and understanding them. And that goes a long way in institutionalizing processes and systems within the bank. There is an appreciation also of the developments in the green space, and I'm looking at my colleague here, Mr. Libanda. So we too, as a development bank, we need to make sure that we are aligning ourselves to attract green investments. Do we have a pipeline that can attract this money? So it's not an issue of lack of capital, as we know, it's an issue of good that can attract investors. Do we have well-prepared projects? That also speaks to internal efforts to make sure that we also have a hand in developing projects a bit early on. we've got a project preparation fund that we try and leverage within our infrastructure sectors as well as industry. However, with the limitations that it has presented itself, at least it still presents a tool to further unlock some of these sectors that we're seeing coming on board. I've also taken note of opportunities in greenfield projects. And this is a space that we play a lot as a development finance institution. If one has a quick snapshot of our loan book, about 70% of our exposure is in greenfield projects. So that just tells you the level of risk that we take. We particularly have a higher level of risk appetite than your normal conventional financier. So this tells me that we actually need to make sure that at the end of the day, we provide financial solutions that are competitive, that are resilient, responsive, and at least that are solution-driven.
Thanks very much, Helen. I like what you said about building a pipeline of bankable projects and how do we go about doing that, and we can get to that in a bit. So I'm now going to turn to Mr. Benedict Libanda. You heard about the green investment agenda. So how does that resonate with you for Namibia?
And everyone hear me? Let me thank the NIPDB for this opportunity. This is extremely very important discussions on investment flows. I will stick to what I know most, that is climate financing and investments, and that's what we'll be doing at the Environmental Investment Fund of Namibia, at least for the past 10 years. We started tracking global climate flows 10 years ago, and we use two sources. One is the global landscape for climate change, which is a network of European-based reporters who reports annual flows of investments. And the other one is the new collective call on climate financing, which is a special committee of the UNFCCC, and it reports annually to the Convention of Parties on how investment is flowing towards green and decarbonization investments. And we are fortunate that EIF serves on one of the task force of this committee, so we've got insight of the financial flows for the past 10 years. I think with what we've witnessed is that from 2012 to 2022, there's been an increase of almost doubling in terms of climate financing at global level. And this has been accumulating to about 4.8 trillion USD by last year, growing at a rate of 10% annually, about 480 billion US dollars per annum. Climate financing flows at public and private capital approach. With public, that's where the multilateral, bilateral flows is measured. At private, it's mainly commercial capital, philanthropic capital. And the increase in climate flow has been fueled by the Paris Agreement, the 1.5 degrees Celsius that we are chasing by the end of the century, and also the policies by governments, especially the EU Green Deal on decarbonization. The transport sector, last year, for example, the EV market doubled, and also the green fuel market also doubled last year. And this sends a message to Namibia that we do have two sectors that are leapfrogging. That is the renewable energy sector and the transportation sector. As we're growing these green hydrogen assets, there is a positive move towards establishing and realizing those markets by 2030, fueled by this growth that you are witnessing. From the Environmental Investment Fund point of view, we have used this inside knowledge learn more about the global flows of climate financing. And we've learned that it comes in different shapes and sizes, large ticket size, technical assistance, grants, lines of credit, etc. And what's so beautiful about it is that different entities, be it large, smalls, private sector, civil society, are able to access these resources. For the past 7 years, we've accessed multilateral funds up to about 928 million Namibian dollars, not US dollars, Namibian dollars. This is mainly from the Global Environmental Facility, the Green Climate Fund, as well as the Adaptation Fund. From the DFIs, we've accessed about 800 million Namibian dollars, mainly from the French development agencies for credit lines. This is concessional rates, and also from the bilateral, access, it's about 1.3 billion US dollars. Over the past 10 years, we've seen grant funding flows increasing by threefold in terms of climate financing. We also try to assist entities at national level on how to prepare themselves, access these resources. What is on the market currently are lots of financial tools that Namibian can access. There is the World Bank Risk Mitigation Facility on renewable energy. It provides guarantees and hedging instruments for IPPs as well as renewable energy investments projects. There is the Climate Finance Facility of the DBSA. It also advances concessional capital on debt and also invests on equity and works with financial intermediaries such as private equity firms and also commercial banks. Also, there's the global SunRef program under the AFT. This is supported by the Green Climate Fund, access funding for climate resilience agriculture as well as renewable energy, and these flows through commercial banks but comes with a technical assistance facility. From a national and policy perspective, to a large extent, we have some policies that direct investment flows in the country and supports an enabling environment. I'm talking about the national determined contribution. We've learned that we need about between 85 to 109 billion Namibian dollars to implement the NDAs for the country. We do have the national policies on climate change, etc. But as new alternative investment opportunities are emerging, like the green hydrogen industry, we need to reinforce and come up with national framework and regulations to guide those sectors. For example, also the green credit, the carbon credit opportunities. The Ministry of Environment and Tourism with assistance from Japan is working on a framework for carbon credit, and we hope that will also open new business opportunities, especially for green attributes and industries in the country. And going forward, what we've learned is that the challenge that is there is mainly at institutional level to align themselves with green and climate focused capital. This is because the transactional cost of alignment is actually high and it's upfront. For example, this green capital comes with a lot of conditions. You have to integrate ESG into your systems. You have to integrate gender and have function for gender mainstreaming within your lending systems, MRV reporting and tracking of carbon emissions and avoidance, etc., etc. And the cost of undertaking that comes at higher risk for an institution, and that has limited access for green financing in the country. And the moment we work around that, we'll be able to increase our access for that. Thank you.
Thanks very much. So there's a lot of money out there, a lot of opportunities. And you've highlighted the importance of institutional alignment as a way to sort of bring everything together. That's an important point. Thank you. Philip, you're the voice of the private sector on this panel. What are your thoughts?
Yeah, it's a heavy burden to carry. Perhaps let me start by also thanking the NIPDB as well as the World Bank for the opportunity to engage on this matter, and also the willingness to have these discussions and debates, because I certainly think it's paramount for us to resolve some of the matters that were raised in this World Bank report if we really want to catapult the economy to a higher level. I think we also have to acknowledge the great work that the NIPDB, as well as the presidency and various stakeholders have done over the past couple of years in making Namibia known to the world, to present the opportunities that exist in Namibia and generate interest into the Namibian economy for investment. I think that needs to be acknowledged, and I think it's now our duty to build on the platform that's been created. And just listening to the World Bank discussion now, and as a commercial bank, a big part of our role is facilitation of investment into the economy. And one of the key challenges we see is that capital can go anywhere. So we have to be competitive as a country in terms of what we offer. And capital come in different formats. So there's certainly the financial capital, but there's also human capital that's needed to unlock some of the financial capital ability to deliver returns. And I think that's where Namibia Inc., as well as the government, needs to see how we can expedite and how we can enable investment into the country, make it easier for people to invest. If you just think about our investment processes, the red tape you need to go through, by the time somebody's managed to set up a business, they are sometimes a little bit disheartened by the heartache they had to experience in getting to it. And I think from our perspective, as a facilitator of capital investment, it is something that we really need to, as a country, work very hard at. And there's certainly a willingness to engage, but I think the speed at which we are executing at the moment is probably a bit on the slow end, and we certainly need to pick up on that. And I think if you think about it from a regional perspective, you've got economies like Zambia, you've got economies like Botswana. They all offer different perspectives. We've got our neighbors with their own problems, but so there's an opportunity for Namibia, but we need to be open to that opportunity. And I think that's maybe one of the key points I would like to, from a private sector, put out there to government, is to also say, let's take hands in creating a framework where we can all prosper. We sometimes need to be a little bit more open to allow investment in, and if that happens, the output will generally benefit us as a country, both in the private as well as the public sector. Let me leave it at that. Thank you.
Thank you, Philip, and thank you for highlighting the importance of business enabling environment reforms, just to make make it easier for businesses to start, to operate, and to exit if they have to exit. Right, Francois, I'm saving you for the end because you and NIPDB are the sort of the tip of the spear here in terms of investment promotion and investment attraction and facilitation. So over to you, Francois.
Thank you very much, and very good afternoon to everyone again. I think maybe if I can just pick on a couple of comments that came from the other panelists. I think one of the key areas, and we discussed it actually before the session, together, is really around reform, and one of your colleagues also touched in their presentation on reform. So yes, I think we certainly hear that maybe in certain areas we're a bit slow, and other areas we potentially far ahead, like Helen indicated, around the electricity sector. But certainly, I think the intention is for us to maybe work harder and faster on being a competitive player in this environment. And certainly, when we look at broadly, when we look at the wider environment around is green energy and green energy projects, but also other green projects, and we increasingly speak to investors about potentially converting conventional mines into green mines, producing green commodities. These opportunities are all, of course, they don't happen by accident. It is a question of, government has very clearly structured itself in such a way through, our various colleagues at, in our brother and sister ministries. And so there is definitely a concerted effort going on. I think the reality of it is that it's not an easy environment to play in. We are a relatively small player in a space where we compete, with the likes of our immediate neighbors. And in some areas, they've been a bit more successful and certainly have moved faster than we have. And in other areas, I think we've been quite very able to kind of leapfrog them in certain sectors and industries. But the challenge remains that there are reforms that we need to continue to focus on. And there in particular, when we look at enabling legislation and regulation, that's still missing from the bigger puzzle. But also in terms of infrastructure, where one of the main constraints we suffer is affordable electricity. And so we'll struggle to industrialize in the absence of affordable electricity, and in particular, affordable baseload. And when we look at the risks around electricity supply in our region, and with a particular view on South Africa, this is something we need to address urgently. And of course, our colleagues are working on this, but I think it is important that the rest of us in SOEs, but also in the private sector, realize that this is a key risk, and we need to pull together, like Philip said, to address issues like this. I think one of the rising stars, and unfortunately, because of rising commodity prices, we kind of a little bit stepping back into that trap of becoming too focused on primary production, because it's convenient and it's easy, and we are under pressure to create jobs and prosperity generally. But there is an opportunity now, and if we kind of look at not only Namibia's interaction with the European Union, but also other trading blocs, to supply critical raw materials, but also to do that value addition domestically before we export those products. And I think for us as a country to kind of continue to apply that pressure on our trading partners, but also at the same time be the kind of the center of a group of countries to say, well, actually, you know what, in the region we have capability X, Y, and Z, and we can produce and process certain metals and minerals and resources here. There's no need to ship our copper to the Far East to have it refined there just to be shipped back to Africa. And I think it is a good shot of entrepreneurship, of being consistent in our messaging, but also, kind of really driving the agenda, and perhaps really as a country, and in particular, the likes of the technocrats in this room, where we stand together and actually stick to the decisions we make, actually implement the decisions we've made. And if we look, for example, at something like value addition or beneficiation policies, that we implement them. We have those mechanisms. And there's a question of us working together to push that agenda forward. I think the upside of it is, and your colleague actually echoed it in a presentation, is that as the world is moving into the service economy in a very aggressive way. That certainly is an opportunity for a country like Namibia. Yes, of course, our education system has its pitfalls and its disadvantages. But I think the one thing that we've found is, and it's not only us, and because we're biased, of course, but we do know that Namibians and young Namibians are trainable. We also have quite a bulk of graduates that are unemployed, and we know, from the experience of other countries that this group of people can be retrained to work in the service industry. And it's a question of how do we creatively, but also quickly, grab that opportunity and convert that, especially with the view on digitalization and the provision of digital services. Thank you.
Thank you, Francois. And I like what you said about not slipping back into being comfortable and being complacent somewhat, because it's always tempting to do that, going back to the familiar, but then the world is changing and there are new opportunities, and so thanks for highlighting that. So now, colleagues, this is an interactive session, so I'm going to turn to you for your insights, your questions. You can ask questions from the presenters, Peter and Priyanka, or the panelists. Please state your name and your question. We'll take a few questions and then we'll get them to respond. Those who are connected online, I'm asking my colleagues for help, whether you can you can post your questions as well online, and we'll get to you. So I see a hand up here, Madam. You can start first. There's a mic there.
Hi. Hello, everyone. My name is Evelina Malwa. I am not representing any company here. I am representing the youth. And I have a question for Mr. Francois. Your last statement was improving the employment sector in regards to dealing with graduates. My question for you is, how do we attract investors to invest in solutions that cater to resolving the unemployment rate issue in regards to us having various amounts and copious amounts of graduates, but them not necessarily having access to employment within our country? That's my first question. My second question would be, after attracting these investors, how do we ensure that they remain in the long run? And at what point, third question, do we then reach a point where we do not need them to remain anymore, when they can make their exit and we can take over in regards to sustaining said, I'd like to call it an institution of sorts? Yes, these are my questions.
Thank you. Francois, we'll just take a couple more and then we'll come back to you. We can take a couple more questions or comments here. Please don't be shy. Sir, at the back.
Good afternoon. My name is Stephen with the Commerce and Industry Review magazine. Given the current situation, the geopolitical situation in the Eastern Europe, whereby we have seen that FDI is being weaponized and used as a foreign policy tool. From a government perspective, we just wonder how many governments would still have the old approach to attracting FDI? Thank you.
Thank you. So I think we'll Peter or Priyanka, perhaps you could take this question on weaponization of FDI. Very interesting. And then Francois, that was clearly for you.
Okay, well, maybe allow me to start. So I think, unfortunately, there's not a one-word answer to your first and possibly second question. We're unfortunately, and we're not the only place in the world where this is the situation. We're unfortunately in a situation where we have maybe not the level of education that what we wanted, and that's, or we don't offer the skills or the degrees or the qualifications that we require in the economy. So that potentially is part of the issue. The other side of it is of course, so how do we attract these companies to absorb these unemployed graduates? Look, I think, and like I mentioned, the service industry in particular, and you can see it in research, that it is more adept in doing that than, for example, manufacturing or mining or any of those. The service industry also typically, it's a way to create jobs quicker and also at a necessarily a lower capital input cost. So the question around how do you retain those investors, look, I think retention is actually one of the, now that we, like Ngula said earlier, now that we're kind of 2 years in the game, we do understand that actually retention is almost as important as attraction in the first place. And so when you look at attraction, when you look at retention as a marketing activity or as an attraction, as part of your attraction activities, it is really important to understand that the world is not static. And to a certain extent, it's really down to creating certainty for the investor like you would have in the first place when you attracted them. But also in the second place, to make it a safe space to operate in. I think we become comfortable, and I'm not saying like we, but like people become comfortable once you've kind of hooked the investor or someone that's interested in your country, and then think, oh, okay, they'll just stay here forever. I think it's almost like dating someone. You kind of you need to continue to make that effort. Otherwise, especially in the service industry, you know, it's much easier to pick up and go. It's much more hard to pick up a mine and go somewhere, if you catch my drift. So I think that's the second point. And your question really around how do we indigenize really companies like this or projects like this. What we've seen in South Africa, certainly when you look at the service industry, but also in other places, so this happens automatically in a way. Yes, of course, you could have policy or regulation that kind of drives this at a faster pace, but also at the same time, I mean, it's quite rare where you find that an industry or a company start a new industry or be the kind of the mainstay of the industry, and then it kind of operates in isolation. You'll find copycats that follow, and that's kind of what creates an industry, right? And so to a certain extent, you'll see that, yes, there might be international players, but that domestic companies will kind of manifest in itself. But again, it's down to us creating that environment, us as Namibia Inc., like Philip said, creating that environment to make it a good and a safe place to operate in. So there's actually a lot of responsibility on us as Namibians to attract that investment. And I think so. I try to, and even in NIPDB itself, we need to recognize that us as individuals play as much as a role as government is playing, and it is important that we kind of create that environment that is, like I said, predictable, safe, and so just really a friendly place to put your money or your well-earned savings, hopefully, as an individual investor. Thank you.
Thank you, Francois. Peter or Priyanka, do you want to take on the challenging question on weaponization of FDI?
Peter, your sound is, we don't hear you. We still don't hear you.
We don't hear you, Peter.
How about now?
Yes, thank you.
Sorry, clearly my computer has a mind of its own and it switches the settings. No, thank you for the question on geopolitics. Indeed, in fact, even as we presented some of our charts, we saw that investors are driven by a key set of considerations, top amongst which is political stability. It's a domestic political stability, but it's also regional, global political stability in which geopolitics is a key consideration. Right? Our work focuses on private investment driven predominantly by commercial motives, a risk and return calculation that any company undertakes in order to decide where to locate. And a key part in this risk and return calculation are also shareholder pressures and shareholder and stakeholder expectations. Who are these stakeholders? They are your customers, your investors and shareholders, your suppliers, but a key stakeholder is also a government. And indeed, a government can help introduce policies that ultimately do affect this risk and return balancing calculation of an investor. And what such policy are sanctions, right? So, sanctions that have been introduced and imposed on certain markets have indeed affected and influenced cross-border capital flows in trade, in foreign direct investment, in private indirect investment into capital markets. In fact, when the war in Ukraine first broke out, we put out a study that we would be happy to share on the likely effects on trade and investment, the dislocations of these flows, and the different geographic patterns that will be emerging. So absolutely, geopolitics and the associated predictability and certainty that investors ultimately seek in being able to project their plans for the investment do affect investment flows as a key consideration. Thank you. I don't know, Priyanka, whether you'd like to bring in.
Sure. So just complementing Peter's point, I think absolutely. We've seen, as Peter was saying, there's a enhanced intermingling of sort of economic governance with all the geopolitical tensions, as Peter showed in his slides. And we've also, I think the only point I wanted to add was, in terms of policy responses to this. So governments are doing things to manage, mitigate, have a framework around managing risks generated because of these geopolitical tensions and the impact it has on broader economic governance. So, for example, where we are seeing countries, putting in place or investors wanting to get strategic assets in other locations, we're seeing governments put in place a greater number of approval screening requirements, but with very clear conditions, with transparency embedded in it. We've seen the European Union do that. We've seen the US introduce a little bit of it with the CHIPS Act. And so there are sort of policy innovations that we've seen essentially as responses to increased geopolitics driving some of the investor decisions, both from the perspective of screening and approval mechanisms, but also the point that we made initially in our initial presentation on how do you ensure that states have enough flexibility to be able to regulate, to manage some of these situations, and what should your internal domestic policy framework look like to manage these tensions. So I'll stop there. Thanks.
Thank you, Peter and Priyanka. Are there any questions coming in from the online participants? There are, but let me just turn to, can you just take them, and then let me turn to you, madam, for your question.
Sorry, I'm just waiting for the online question.
No, you can go first while we get the online questions.
Just allow me to introduce myself, Meryl Barry, speaking on behalf of the Papkowitz Foundation. I would like to respond to the young lady's question. Thank you for that. I can vouch for the NGO space where for many, many years there has been a great investment into the Namibian youth on various age levels. So that is, it also, in many, depending on the actual models, it also incorporates youth training. Like for example, one that comes to mind is where they've taken a lot of or invited applicants from various sectors to be trained as coaches for digital work in mathematics, in after-school maths for government schools. So it's usually like a three-way partnership. So there are many, many. I can think of another one just offhand where foreign, and that is an investment. Foreign investors then, sorry, I was getting a bit nervous speaking on this forum. Yeah. like people, investors have either their expertise or their preferences, if I can put it that way. And another one that I can think of is very keen to work with marginalized communities where they have then started entrepreneurial ventures together with them, which involve training, and they are usually located like regionally, quite specifically. I just wanted to say that there are quite a lot of things out there. Another very important one is like inter-university relationships or partnerships between universities, of which I can also think of a couple, Belgium with UNAM, the university in an Italian university with UNAM, and so on and so forth. Thank you for your patience. And, yeah.
Thank you. Thank you. So just an online question here, which I'll take before I come back to you. There's a question from Arun Kumar from the African Development Bank. He says, thank you for the presentation. My question is related to developing the healthcare infrastructure in Namibia. Please advise. Francois, I'm sorry, can I turn to you, please?
I think you're unfair, but okay. Ganesh, I think it's, in particular when we look at infrastructure and the role infrastructure plays in enabling agent, if you like, in development. So I think one of your colleagues touched on, for example, grid development. We spoke about, or we speak about rail in government quite often, and how important it is as a enabling factor. And I think part of it really speaks to our ambition as a nation, and part of it speaks to the fact that unless we're going to do it, it's not going to happen. I'm sure those of you that are on Instagram, there's this thing that kind of comes by every now and again. Is no one is going to save you. You need to save yourself. And I think this is where we are at the moment. If we want to make it happen, then we need to drive it. And so to a certain extent, we've seen, unfortunately, really since 2014, it's been, fiscally, it's been very difficult for government to kind of drive these opportunities that can kind of unlock key pieces of infrastructure. But that hopefully will, as investment manifests, but also kind of we can see that there's kind of a general unlocking of available capital, like my colleagues alluded to earlier. But it is a question of how do we actually partner with, yes, our neighbors? How do we interrelate and cooperate with them? And like I say, I think to a certain extent it depends on what our ambition is. So part of the strategy we're working with the Ministry of Mines and Energy, for example, is really to pitch Namibia as a sustainable energy hub. Yes, of course, there's a lot of things that makes it a difficult thing to achieve. There are a number of factors that you need to kind of keep in mind when you do develop a strategy like this. But the reality is we have the bare bones and the primary building blocks of it in place already. We have excellent wind and great solar resource. And I think so it's these opportunities, the obvious ones right in front of us, that we need to capitalize on and really convert those into something that serves the economy and the nation. Thank you.
Thank you, Professor. Thank you. There's a question from the back.
I have actually three related points. Sakaria Ngikembua, Momentum Metropolitan Namibia. Two are comments, and then I've got a question. I think the first comment is really, I'd like to echo the sentiments that Philip, I think, put on the table. And that's really around the need to remove bureaucratic red tape. I think there is just too much red tape in various aspects of our national governance architecture. And the challenge is actually that it's uncoordinated red tape, if I can put it that way. That you've got different institutions that are supposed to sort of drive the same end objective, but they are all going off and working in different ways, their own timelines, their own setups, and their own sort of philosophies. And therefore it becomes very long and frustrating. I mean, just to set up a company in itself is a mission in this country. To get different types of permits is actually another mission in this country. And you know, to even bring in skills that you might need, you know, just to drive some of the investments is itself also a mission in this country. And so I think it is true that investments and investors will then go somewhere else, you know, where there is coordinated efficiency. I think that's just a comment I'd like to make. I think the second one is really around the need to be open, and literally be open, I think in the widest sense of the word, and just be practical as well. So in this country, we import around 80% or so of the food we eat. And I think that's quite risky because it makes us vulnerable, but it denies us jobs as well in Namibia. And it's not as though we do not have the land. And I want to be very practical with a practical example of the green schemes, land which government has handsomely invested in terms of infrastructure. But it's actually not producing what it's supposed to produce. And what you really need there is investors with money and the skills to come in and actually kickstart these projects and provide jobs to Namibians. Provide jobs, and you can provide quite a lot of jobs in those settings. And those jobs that primary agriculture will create will actually, in the end, also provide opportunities for value addition. So you will create jobs also in value-added industries while ensuring your own food security. And I think one can look at many other examples, you know, not just in agriculture. So I think it's quite important that we are open and practical, and that we deal with these things very quickly, you know, and not be out there for 2-3 years, you know, still looking at request to whatever it is called, RFP, you know, request to invest. You know, it can never work that way. If I'm looking for an opportunity right now, I want it now, or else I'll go where it is. So I think that's just a point I would like to make. Then the question, maybe to you, Francois. I know it's unfair, but you are the one on the podium. So how do we coordinate our efficiencies and the different institutions so that we really can create a one-stop institution or one-stop concept that can really make it very easy, efficient, and pleasant to actually invest in Namibia?
Thank you. That's not an unfair question. So maybe if I can start with that, and then we can move on to someone else for one of the others. So as NIPDB, we actually started the process of putting together a physical one-stop shop downstairs. Was it towards the end of last year? Of course, we can't do this in isolation, and it's important for us to work with our colleagues in government to do that. A number of ministries have actually committed already to provide staff that will work from our offices on a daily basis to support investors and deliver those kind of key services, things like work permits, permits that you would require from MEFT, for example, and you know, other similar ones. In the mining sector, we'll have a couple of advisors here from the mining sector that can actually speak to investors, you know, around mining licenses, exploration licenses, etc. But I think but that's merely step one. And of course, like I said, it kicked off towards the end of last year, and it is a process, of course, for those ministries to mobilize people, to make the fiscal and financial commitment to have a dedicated person here at the NIPDB office here at Investment House. I think the second phase of it is, and it's a bit more of a complicated answer, which perhaps we can talk about afterwards. So there used to be a system that was run by our colleagues at the Ministry of Industrialization and Trade. A decision was reached between ourselves, MIT, and a number of other parties, like BIPA and other service providers, to move that system to a new platform. Again, so we're talking about capital expenditure that we don't necessarily have and we need to plan for over subsequent financial years. But it is something that is in the planning to also digitize some of those services and to allow not only foreign investors but also Namibian investors to access those services digitally. In terms of service delivery itself and targets, I'm very proud to say we've just actually concluded our own round of strategic planning. And one of the key things that we say to ourselves is that actually, like you say, it becoming a mission to register a company is simply not acceptable. If we look at what our competitors are doing next door and further afield, then it taking days or sometimes weeks to register a company, it doesn't cut the mustard. And so we will be working with, yes, BIPA, but also the other role players in this space to drive down those delivery times very aggressively. And that's so that hopefully by next year, if we have the same conversation, we could show you the dramatic improvement in those delivery times. Look, we are dependent on people working with us. We can't do it on our own. And certainly it's not our credit to take, because at the end of the day, those agencies and ministries will still continue to deliver those services to Namibians and to investors. But we're there to support them. And sometimes it's a question of being the change agent or the thing or the person that kind of just start the change, but the change will happen with those institutions themselves. And we look forward to continue to support them into really serving Namibia better. Thank you.
Thank you, Francois. That's very promising. I mean, the things you're mentioning are very exciting indeed. Are there any other, Madam CEO, and then there's two more questions or comments.
Thank you very much. And I think many good points have been raised. I think, especially where we are sitting as NIPDB, we are addressing most of them, like Francois has said. Probably the wheel is turning. Of course, it does turn slowly. But I think what one can assure every member, maybe especially from the private sector, is that the commitment of government is there for us to serve investors better, for us to solve the challenges that we are facing. And therefore now it's just to make sure that our processes and our structures are aligned to that commitment. And if you do come across an investor who is struggling to get service to government, please send them to us. I think in the interim, while the system is working, every investor that you meet, of course, the definition of investor, it's another thing, we can talk about it. But it's every investor who's coming to provide job opportunities to Namibia and invest a significant amount, and they tell you, no, I have applied somewhere and I'm struggling to get an answer. Please give them our contact details, because that is actually what we are doing every day, is unlocking those opportunities. And yes, one thing that Zakaria mentioned is they've got different philosophies. We have found that one, and we are trying to make sure that we are all aligned in philosophy. The one point that I wanted, there is 2 slides that are in my head since the presentation. I don't know whose presentation was that one. And that is the flow of FDI. For example, we are seeing where, of course, FDI is flowing from regions. So it's a graph that has got lines as to where it's coming from and where it's going. And of course, we are seeing that there's trends in FDI flowing, for example, from China somewhere else. And of course, there's a concern there that what is flowing to sub-Saharan Africa is very, very little. So the question there is, of course, we can always assume that it's because of we are all put in one basket in its political risk. What is it that is driving that? And maybe how can we, of course, as Namibia, position ourselves to make sure that that FDI that is flowing from somewhere else kind of gets to us? And yes, maybe we will get our fair share and sub-Saharan Africa is not getting. But I think, why is Africa's share almost even decreasing when it is already low? And I think that is something that I would like to know more so that we can see how to engage. The one thing that Helen also mentioned, and it is important, and that is probably the message I want to give to most fellow Namibians, is projects. So what we have found, again, like I said, there's a lot that I found out that I didn't know, is there's investors, like in terms of institutional investors, and then of course there's investors with know-how and their own project that they promote projects. Now, currently we have got a huge pipeline of investment project, and that one is mostly foreign investment, because we are not getting Namibian-driven project into that pipeline. So if we are not getting Namibian-driven project into that pipeline, is it because we do not have project? Is it what it is? What is the reason that we are not getting? Is it because maybe we are having those projects and therefore we are delivering on those projects ourselves, of course, without the support? And that's why I say, if you've got an investor struggling, send them to us, because we actually put them in our pipeline, we assign somebody to them, and that person helps them. So as Namibians, when you're living here, there's a lot of institutional investors that want to invest in projects, and they are always asking us, please give us projects where we can invest. We do have projects that are driven by foreign nationals. We lack projects driven by Namibians. Please take that message out there and let us see how we as Namibians can start driving projects. And we're talking about land. I know that, yes, we need green scheme. But Namibia is such a huge country, and the whole land is not owned by government. What are the private farms in Namibia doing? We can have people that own private land actually structure that one, and we can probably promote investors into those particular assets that the individual and private Namibians have. Thank you.
Thank you, Mrs. Nangula. CEO, I love that commitment. If you have investors with the problem, send them to me. That's personal commitment. Thank you for that. A question here and one more, and then we have to wrap up with a closer.
Can you guys hear me? Okay, perfect. The first is not necessarily a question, but in regards to what Zakaria said in terms of organizations not really aligning, from my studies, I have understood that the main issue, especially within the Namibian context, is that we do not have strategic plans that are aligned. Every organization has its own strategic plan and its own manner of caring, even though they all want to tackle the same social problems. For example, you all want to resolve the employment situation, but we can look at an organization, for example, such as the corrections, for example, right? But they have individuals who are graduates, but they're more likely to employ individuals based off of things such as fitness and etc. The criteria, they don't align with their strategic plan. And even outside of that, their strategic plan does not align with the court system strategic plan. It does not align with the policing system. But they all have the same goal, which is to reduce crime, right? And to rehabilitate those that are affected by these structures. So I think, as a Namibian youth, as an outsider looking in that knows nothing about these here pre-existing policies and laws, if you all sat together, your top industry professionals, and you came up with a collaborated strategic plan, not necessarily to resolve all of the problems, because you can't, right? Every industry has its own, but the main problems such as employment rates and whatnot, and you curate and design something that works where everybody wins at the table, I think that would impact Namibia greatly in terms of its development. The second is an answer to your question, Bam, which was why we don't have Namibian-driven projects. As someone who refers to herself as a social innovator, I find one of my greatest struggles when I come up with solutions is one, there are a lot of roadblocks. You don't have the right qualification. You don't know the right people. You don't know where individuals such as yourselves gather and have these. I mean, I only found out about this morning on Twitter, and if I had decided not to go on Twitter, I wouldn't even know. And there are a lot of young people that don't know that they can come to your offices and that they can pitch. And even when they have the idea, they don't have the skills, right? They don't know how to draft proposals. And because of these minute things, they are often discouraged to pitch up and say, look, I have seen it all. And perhaps I don't have the industry experience. Perhaps I am unable to draft a proposal, but I have the idea, and I can break it down for you, and you that is equipped in that can help me. So I feel like if we focus more on mentoring Namibian minds, not based off of the pre-existing academic criteria, but more on their ability and potential to produce solutions, that would help greatly. Then you'd have Namibian solutions within your pipelines, because then you'd have Namibians that have these solutions, and they're not hindered by the bureaucratic red tape that exists of, please know how to draft a proposal, please study for 4 years, then you can come talk to us. So it's all about meeting the Namibian youth where they are. And where we are is we're on social media. We tweet, we send you emails, you ignore us. And it's discouraging, you know, you sit at home and I have a wall that has enough solutions and I spend time studying it, but I have nowhere to pitch, no one to talk to, and I don't know who to ask to teach me how to go about getting these things done. All I do know is that every now and again you have panel discussions, and if I'm lucky enough to have the time, I can avail myself. And yeah, that is all I have to say for right now.
Well, thank you for those refreshing insights from the youth. I think there's a reality check for all of us to be able to reach out to everyone. So the last question or comment from you.
Thank you. My name is Emmanuel Nashivela. I'm from Ministry of Finance. I just want to thank NIPDB and the World Bank for the initiative. And I also support the notion that we need to improve our processes and the efficiency to gain efficiency, and also to make sure that the investment flow efficiently. Yeah, my question was aroused by one of the presentations. It's not a new concern, it's actually an old one, which says that there are many restrictions on our law when it comes to the investor, especially on equity, and they also mentioned that on some sectors that are not allowed for the investor. So my concern is that, or my point is that most of those restrictions, I think, were put in place to bring into balance some of the perspective into our society. For example, to make sure that the Namibian have shares in a development process, and also to make sure that we address some of the problems that are facing, or socio-economic problems that are facing our society. Some of those ones are historic and so on. So we are hearing that we have to remove restriction. Of course, that's a good thing to do. But how do we balance between now addressing those issues and also making sure that we attract foreign direct investment? Another thing is also to make sure how do we ensure that we attract sustainable FID, because we know that in the past we have issues where investor came and they stay only for a few years and they go. So how do we make sure that we sustain those investments? Thank you.
Thank you very much. Peter, Priyanka, maybe the two questions here. One is on the scorecard for Namibia. If you have any reactions. There was a question from Ms. Nangula on the FDI flows in Africa. If you have any reactions to those questions, then we can wrap up and turn to the closing comments.
Sure, I can quickly come in on the last point made. And so Absolutely, fully agree. As we mentioned, the results or the data collected in the scorecard is essentially a baseline of what exists in the country based on certain standardized metrics, right? But the question of reform is really very country specific. And as you're rightly saying, there are so many considerations going into what should be reformed, what should be changed. Everywhere we've seen, the resources within the country, the political economy, the institutional capacity, the history, just the strategy going forward. All of those would determine what kinds of restrictions are feasible to eliminate. So by no means is it suggested that all of those need to be removed. It's essentially highlighting some statistics on what exists, and then the question of reform is really one to be determined based on all the context that you rightly identified. And then second point was on ensuring the sustainability and continuity of investment, and this is where we referred to how, and I think a lot of panelists refer to it, how investors are really treated in the country. And not just Namibia, we've seen this happen in several locations. Divestments, Peter already spoke about, the FDI stats globally in the last 2-3 years. But we've seen divestments, we've seen investors stay for a bit, but then either divest or not expand, not diversify. And in our experience, a lot of that has to do with how investors are treated. So that includes, and it's a combination of, the kind of rights they have in the country once they establish in the country, but very importantly, how services are delivered to those investors. So, if they have issues, concerns, how effectively are they addressed? How timely is that experience? Do they have a place to go to report these issues? And then what is the kind of institutional setup or coordination mechanism within the government to effectively respond to these issues? We've seen, these types of interventions can help in maintaining continuity and hopefully encourage expansion as well. And we're separately happy to share additional information, that the team has prepared on some of these topics. Stop here, thanks.
Thank you. Maybe let me offer a 3-point response and reflection on the FDI potential in sub-Saharan Africa specifically. First, obviously, it's a heterogeneous region with many economies characterized by different features of their economies, of the governance structures. But one key thing that most people do not know is, in absolute terms, Africa attracts only 3% in global FDI. However, in relative terms, Africa's FDI inflows constitute a larger share of their economies and of their total investment and total GDP than on average in the world. So it's important to take, I think, not just an absolute perspective, but also a relative perspective, and show new potential investors that, given the size, the relatively smaller size of African economies, Africa is already doing quite well relative to other developing regions and the rest of the world in attracting FDI. So I think that's an important message from investment promotion and outreach perspective as well. It's a relative perspective, not the absolute perspective. Second, the changing patterns in FDI that we were referring to. Geographically, of course, we see a lot more FDI to Africa coming not just from the traditional sources of Europe, of North America, of East Asia, but also from the Middle East, from South Asia, from Southeast Asia. And this pattern has only been intensifying. A second key emerging pattern is a growth in intra-regional investment, not just from South Africa, but also from West, East, and other sub-regions in the continent. The second changing pattern is in terms of the sectoral and industrial composition, the rise in services FDI, and some of the trends that you yourselves have commented on throughout the seminar on renewable energy, on green energy, hydro, and that's a global trend with more and more opportunities. In fact, looking at the 2022, just last year's data, and the global trends there. Renewable energy sector is the single fastest growing sector in the world for global FDI. So definitely opportunities there. The third reflection, going back to the role of policies, laws, and regulations, we referred to the promise of the African Continental Free Trade Area and the investment dimensions under that agreement through the investment protocol and the services protocol. Our own calculations suggest that should all countries align their domestic rules with the commitments under the AFCFTA, intra-African investment amongst the member states will more than double in the next few years. So removal of the types of existing barriers that's also envisaged under the regional agreement really shows great promise to unlocking the potential for increased investment, not just from outside of the region, but really within the region as well. Thank you.
Thanks very much, Peter and Priyanka. With that, let me turn to my panelists if they have any parting words of wisdom before we close. Philip, 1 minute.
Yeah, no, I don't have many parting words. Just a big thank you to NIPDB and the World Bank for hosting us. And I really hope that the perspectives that were shared today, we can take forward in a collaborative way. As I said, I think there's a duty and an obligation to both private sector as well as public sector to move together on this journey. And certainly from our side, very much committed to it. And thank you for having us.
Yes, thank you. In closing, I would just like to say I have definitely appreciated the need for stakeholders, especially, at least let me speak for financial stakeholders, a need to stop working in silos and really come around the table where we've got cross-cutting solutions that we can give. Many a times you'd find that we would even meet outside the country. And we find ourselves introducing ourselves outside the country. This is what we offer. But it has to start at home. We need to start the dialogue at home. There are synergies that we can leverage off each other so that when you come to us, we're speaking the same language. And thank you for the invite. And looking for more similar opportunities that I'm sure will come.
Yes, I think just to echo the previous speaker, I also realized that we haven't been reaching out to stakeholders on what we do, specifically the NIPDB. I see that we need to provide more information to your office when it comes to investment, fundraising, and what we're doing at the ERF. That will need, major improvements. Same as the DBN. I see synergies in some of the products that you are delivering, within the institution itself. And I think at one point, again, we need to collaborate and discuss. We have heard the youth pledge, and something that the ERF is working towards. The Minister of Finance, about a week or 2 weeks ago, tabled the budget for the 2023-2024. Within the budget, the minister announced a green concessional facility which targets youth entrepreneurs. And we hope to start with that facility in terms of disbursement and approval of projects by the 15th of March. It's highly concessional, $2 million Namibian access to targeting youth, prime minus 6 or 7%. Looking at about 1 to 2 year, period for the window, and then about 8 to 12 years of repayments. But there are just some finer in-house details that we're finalizing. But you are welcome to visit our office should you need such assistance. It targets renewable energy, energy efficiency, sustainable agriculture, biomass, waste management, etc. we'll be happy to assist you on that one. I think, thank you so much for the invitation once again to the NIPDB.
Thank you, Benedict. Ganesha, yeah, so I think the major lesson we all learned today is really around collaboration and working together as Team Namibia. And of course, I'd like to invite the audience as well, that if you have questions or contributions that you feel you could make to this journey that we're on, to please come knocking. We're always here, even late at night. But I think the mere fact that so many people joined online, but also the fact that you're here means that you have our country's best interests at heart. So thank you very much for being here this afternoon as well.
Thank you, Francois. I love the energy in the room. So with that, it's my pleasure now to invite Mr. Sikongo Haihambo, the Executive Director of the Ministry of Industrialization and Trade, to deliver the closing remarks and close the event. Thank you, sir.
Dr. Philip is a gentleman. He wanted to stand up and offer me the seat. That's now typically Namibian. Good afternoon. As it has been said, my name is Sikongo Haihambo. It's not a face that you see regularly, because this face is in the office for I don't know how many hours a day. But from time to time, we are honored to pop up and then say a few remarks. We appreciate this initiative very much from the NIPDB, as well as the World Bank, the panelists and the presenters, Priyanka, Peter, and then here on my immediate right, Helena, Francois, Benedict, and Philip. Sorry that I had to go by the first names. That's what I'm used to. But I think that you're comfortable with that as well. The session has been highly informative and highly enriching, including to those of us that are already in the industry. And I'm talking about me sitting in the office of the Ministry of Industrialization and Trade. I was still able to pick up a lot from what was presented. I'm standing here not only in my capacity as the Executive Director, but a person who's closely linked to the process. We're talking about the framework, we're talking about the legislation. I am part and parcel of that. So therefore, on a personal note, I was able to relate, I was able to see myself. It's like a mirror in front of me. Where do we go wrong? Where did we get it right? At the moment as we speak, we have what's referred to as the FIA, not fear, FIA, F-I-A, Foreign Investment Act from 1990, and I think it was amended in 1993. It has been found very, very wanting in so many areas. You can imagine around 1990, there was hardly any talk of green hydrogen, fourth industrial revolution, and all these wonderful things, competitiveness, etc., etc. We're just happy we're independent, and that is it. So therefore, we've come to realize that the surface on which we stand has shifted. So we better shift with it. And within the wisdom of our government, therefore the creation of NIPDB, and even more so to give it prominence. If you look at the mandate of the NIPDB, you can easily relate it to the Ministry of Industrialization and Trade. That's why, therefore, there's a confusion. In Angola, I think at a point in time, we have to say, all right, fine, let us go there and then clarify how we relate to one another. Because believe you me, I still receive people writing to me asking about, I would want to invest. I said, please go there. I would give a bit of a background, but I'd then refer them. And I think even on her side as well, there could be some people who are not so clear. Because we are busy transitioning. As we speak, for the past year, close to a year, we have been preoccupied with the investment law. The investment law basically is at the stage of a bill to repeal the fear, because the fear is not good at all. It's not going to be useful for us to say we're just going to tweak it, because the gaps are very, very huge. We have reached a stage as a technical committee where we have concluded the draft that should be ready for us to take it to our principals. That's now the cabinet, respective cabinet committees, and the legislative process moving forward. That is where we are. Hopefully, and I'll be one of those that would be very much disappointed if we're gonna go and reach December without us having that act in place, because we need it. There's been many, many challenges on the side of NIPDB, because how do you move? There are certain areas, and I was able to see Menangula trying, why can't we come with temporary measures, this and that? Because the energy is there, but however, the enabling legislation is not there as yet. But in a true Namibian spirit, we've been marching on, and we continue to move on. Hopefully, sooner rather than later, we're going to say, yes, we now have legislation, proper legislation in place. Competitiveness of the country is very, very important. We saw 4%, sub-Saharan Africa, 4%. The 4% tells us, yes, in spite of the very good explanation, that there is an opportunity for us to grow, because that's what it is. If you are on the ground, you cannot fall anymore because you're on the ground. The only thing is for you to rise, isn't it? So we are going to rise. We have started. The ground is fertile for us to do just that. So the presentations, if one looks at them, and you look at where we are, the reflection that I was alluding to is to say that if for whatever reason we missed out on something, maybe we need to just address that, so that once the piece of legislation has been enacted, that we do not come back after a year and say, oops, there is this aspect that we missed. And I think if that's going to be the case, it should be on us. Because looking at how this piece of legislation has been going back and forth, there's some bad to it because time was wasted. But the good to it is that we are now here. We have learned a lot. Within 2 years, I can guarantee you, the colleagues here at NIPDB, they have gone through a lot. For us to be saying that, yes, at least we're able to pick up a bit of experience, it's much, much better than 2 years ago. And we are able to run moving forward. Yes, we are, as a nation or as a country, still work in progress, but this is the progress that we're talking about. Menangula, we encourage you to continue engaging us on platforms such as this, which should go beyond Windhoek. Yes, we know that there are colleagues that have joined virtually, but from my village, there's nothing like this Zoom and whatever. So those people, they also need to know, but I believe in my heart of hearts that with time, we'll be able to get there. So Namibia appreciates the efforts coming from NIPDB. Thank you, the wonderful panelists. This is not about us, the ones with ties and sitting in a public service office. If it is about the private sector, it's about the investor. And when we talk about investor, within this current bill, it's not only foreign direct investment. I was asking Menangula that, FIA only talks about foreign investors. Now, the current investment law is talking about both foreign as well as domestic. I said, all right, how do we call it? And then she quickly whispered in my ears, it's domestic direct investment. Those of us with deep pockets, as Namibians, this is the opportunity, because there's going to be incentives for you to cover that space, for you not to complain again. Let me not get there. Let me not get there. That foreigners have come, they've taken over. If you are able, please, let us fill this space. And it's even better because we know our country much, much better than anybody else. On that note, let me thank you all very much. Let me also thank you for the opportunity given to me to be with you. Let us take hands and then move into the future. Thank you so much.
Thank you, sir. Ladies and gentlemen, please join us for a cup of tea or coffee outside and some refreshments. And thank you again for attending today. If you're one of the young technical people, for session 2, it will start as planned, I believe at 5:30. Thank you very much.